Thank you, Yusuf. Good evening, everyone. I welcome you all to the earnings conference call of Mars Financial Services to discuss the Q2 and H1 FY24 performance of the company, discuss industry trends, and also the outlook. We have the senior management team of Mars Financial with us, represented by Mr. Kamlesh Gandhi, Chairman and Managing Director, Mrs. Darshana Pandya, Director and CEO, Mr. Ankit Jain, Chief Financial Officer, and other members from the senior management team. I would now like to hand over the call to Mr. Kamlesh for his opening comments, post which we can open the floor for question and answer. Over to you, sir.
Thank you, Sridhar, and good evening to everyone. I'm very happy to connect with all of you once again. So you might be aware that we had a very strong Q2 for the year, and this is our 114th quarter of consistent performance. And the growth in AUM is 27% on consolidated basis for the quarter, taking our consolidated AUM to 9,500 crores. That gives us the confidence to cross 10,000 crores in AUM by the next quarter, that is Q3. As shared with you earlier and during the starting of the year, we had forecasted that we should cross a very important milestone in our journey of 10,000 crores. And that too backed up by very strong fundamentals in terms of asset quality, capitalization, and liquidity management. If I brief you on few of the vital things happening in this quarter, that we consolidated our distribution network to 171 branches and a formidable reach of more than 10,000 centers and this is contributing around 67% of our total AUM, and this is slated to increase going forward. Our distribution through NBFC partners is also very robust, and that contributes close to 36% of our AUM. So both our distribution channels are working very nicely, and we are strengthening both of them, and going forward we see the momentum to be maintained. Very importantly, we will continue to focus on digitalization and building up a very strong team for the same, along with focusing and nurturing and grooming our human resources, which stands as a strong team of 3,000 as on 30th September. I'll take you through some of the basics of this company, while Darshana and my colleague Ankit will take you through the detailing as far as the numbers are concerned, while numbers are already with you. But friends, just to share with you what differentiates us throughout this growth story is a major growth which is non-dilutive and mainly through internal accruals. If I just refresh the memories, we went to capital market way back in 2017 when we were close to 3,000 crores in AUM as compared to almost 10,000 crores currently, and this growth has been achieved mainly through internal accruals. And that creates a non-dilutive growth and a value and tremendous value for the investors. On our subsidiary, as far as our housing finance subsidiary is concerned, that also registered a very strong growth of more than 30% and is poised to grow at a 30 to 35% going forward. Thus, it will contribute very positively to the overall growth of the company. So all in all, it was a very good quarter for us, and it is building up the right momentum at the right time to capitalize on this growth, and we see no reason why we will not be in a position going forward and are confident that we should be in a position to register a growth of around 25% with very extremely strong fundamentals as demonstrated over the last 28 years. So if you say Mars, we have delivered a very consistent CAGR. If you plot it on a CAGR, if you plot our journey of 28 years on CAGR, it translates into a 36% growth in AUM and 40% growth in profitability, having started with a very low base of 2 crores back in 1995. And throughout the cycles, we have grown very consistently. And if you take the last 10 years growth also, we were 1,000 crores in 2013. And I like to take the liberty of keeping it as a 10-year horizon, that 23 December, we are exactly 10,000 crores, translating a 10x growth in our AUM and also corresponding growth in our profitability. So all in all, we are very confident, and we believe that what we have been doing for the last 28 years will continue to grow. We are at a very strategic inflection point, and now we have the critical mass also. 10,000 crores is a good number. to take this forward and to make this company a very formidable company in terms of size, but nevertheless, not only size, but with very strong fundamentals. So with this opening remarks, I would like to hand over to Darshana to take it forward on to take you to the basic numbers for the quarter and the half year. Good. Over to you, Darshana.
Thank you, sir. Good evening, everyone. And I'm happy to share the results of 114th quarter, and that is well within the sync with our strategy of growing at 20 to 25%. And I'll share with you the standalone numbers. So first, for the parent company, if we look at the AUM, we closed at 9,046 crore in September 23, which was 7,138 crore, which is 26.73% growth in AUM. Our portfolio consists of total 5 products. Out of that, SME and micro enterprise loan is 83%, and Wheels is contributing around 13%, and salaried personal loan is 4%. If you look at the individual numbers, micro enterprise loan grew at 18.68% from 3,589 crore to 4,260 crore. SME loan, there is a growth of 21% from 2,671 crore to 3,232 crore. Two-wheeler grew by 32.80% from 470 crore to 623 crore. There is a growth in commercial vehicle of 103% from 273 crore to 556 crore. And salaried personal loan, being the new product, it grew by 179% from 133 crore to 372 crore. Our total income on quarterly basis grew by 30% from 229 crore to 298 crore. Profit before tax, there is a growth of 23.11% from 65 crore to 80 crore. And profit after tax, there is a growth of 23% from 49 crore to 60 crore. If you look at the half-yearly numbers, our total income, there is a growth of 35.30% from 427 crore to 578 crore. Profit before tax, there is a growth of 23% from 127 crore to 156 crore. Profit after tax, 23.61% growth from 95 crore to 117 crore. While we grew by around 26%, we could maintain the quality of the portfolio. Our gross stage 3 asset is now 2.17% as compared to 2.13% in June 23, and net stage 3 asset is 1.47% as compared to it was 1.47% in June 23. And we still hold on to 18.79 crore as a management overlay, which is 0.27% of our total on-book assets. Now coming to the housing numbers, here also we could register the growth of 31.83% in AUM. So now the portfolio is we crossed the milestone of 500 crore, which was last year 380 crore. And total income is now from 11 crore to 14.74 crore. There is a contraction of just 60 lakhs impact due to our expansion mode. We are on expansion mode. We have increased our team strength. So that has resulted into this. So now the profit is 90 lakhs as on September 23. And if we look at the half-yearly figures, total income, there is a growth of 38.69% from 20 crore to 28 crore, and PAT as on September 23 is 3 crore 49 lakhs as compared to 3 crore 54 lakhs, which is just 5 lakhs less than the earlier period. And here also the portfolio quality is still very good. Our gross stage 3 asset is 0.79%. As compared to 0.55%, and net stage 3 asset is now 0.74%, 0.55 as compared to 0.50%. So this was about the housing finance company. Now I'll request Ankit to take you through the capital and liability management.
Thank you, Madam Sir. Hello to all. In terms of the capital and liability management, the company, through its efficient liability management, was able to maintain average cash and cash equivalents of around 800 crore during the quarter, and the unutilized cash facility of around 375 crore. In addition, the company has, around 30 September, has sanction on hand to a tune of rupees 1,770 crore in the form of term loan, direct assignment, and co-lending. In the second quarter, company did around rupees 489 crore direct assignment transactions, and further we have more than 1,000 crore sanction on hand, which will be utilized during the current year. Our strategy, we aim to maintain around 20% to 25% of the AUM as off-book through direct assignment co-lending transactions. The company has available cash facility of rupees 1,765 crore, out of which we utilization level is around 65 to 70%. This is always kept as a liquidity buffer. We successfully rolled over around rupees 1,350 crore short-term working capital loans, which are sub-limit to these cash rate limits. In the quarter, we raised around 1,085 crore term loan, which had an average maturity of 3 to 5 years. This helped us to further strengthen the asset liability maturity pattern. In terms of asset liability maturity pattern, there is no negative impact, and all the community buckets change positive. The capital equity remains strong at 25.17%, with Tier 1 capital of 21.17% and debt equity of 4.12 times. The cost of borrowing for the quarter was at 9.79%. The cost of borrowing in last September quarter was 8.95%. We see that the cost of borrowing has sped up and will settle around 9.75 to 9.85% in the current year. As per the current sanctions on hand through various instruments, we have already tied up for the fund requirement of the whole year. And so in the next half of the financial year, our main objective in terms of liability management will be to focus on the further diversification of sources of funds and to reduce or maintain the cost of borrowing. Thanks. So I will hand over the mic to Kamlesh for the closing remarks, and then we'll be open for Q&A.
Thank you, Ankit and Deshavan. So this is from us. We are open to take the questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our first question is from the line of Omkar Katmakar from Bonanza Portfolio. Please go ahead.
Hello?
Yes, Mr. Omkar, please go ahead.
Okay. So, first question is the salaried personal loans that we have added as a new product. It is currently, I think, close to 4%, if I heard it correct. And it has shown a phenomenal growth on a YOY basis. So what is the traction in that segment, and what is the overall percentage that we are targeting for this to be a part of the total AUM size?
I think to answer your question on what we target, also is a very huge market to be served, but we're very cautious because we're unsecured and it's a new product for us. So we'll be keeping it below 10%, and that 10% will be achieved over a few quarters. So if you see that we are now stable at around 3 to 4%, so within next few quarters we will be reaching not more than 10%. So the idea is to keep it less than 10%.
Okay. And secondly, I was not able to find the number on the spread, the overall spread for the entity as a whole. If you could help me understand what is the spread of the entity as a whole.
So we maintain 7% NIM as in Q2. Our net interest margin was 7%.
Okay, 7%. Okay. And finally, with respect to the co-lending space, so are we going to aggressively go ahead with that, or are we fair enough, because it has been stable from the 25 to 15% range over quite a few while. So is this continuing to be the same, or will this increase as we go ahead?
So co-lending has its own operational issues which have to be sorted out in terms of alignment of understanding between the banks and the NBFCs and at the ground level. So once that gets sorted out, we will be having around close to 10 to 15% as co-lending and over a period of time. And overall on de-risking or on off-book, we would like to maintain anywhere between 20 to 25% on off-book.
20 to 25%. Great. And on the housing finance company, so we can see on a year-over-year basis, there has been an increase in the net and the gross stage 3 asset. Although it's marginal, it's like 8 from 0.43 to 0.55 and 0.59 to 0.79. But because what is the target range? What is the upper band that you are looking at that will cap the NPAs at? And specifically, what is the reason for this jump in the asset quality? So
0.55 or 0.71, they're all range bound figures. So when you are so low on your GNPA, you have to talk about range bound. So it is range bound, and on a vintage basis, as the portfolio matures and as the portfolio grows, we will see this net NPA ranging anywhere between 1 to 1.5% as we go forward, as per the industry standards. Right now, because of the low base and more focus on quality, we are in a position to maintain it at half the level of the industry standards, especially in the affordable housing space.
Okay, so I was going to come to that question only. What is the exact vintage of the portfolio, average vintage of the portfolio?
Average vintage of the portfolio on critical mass must be around, say, 36 months, 36 to 48 months on a critical mass. Because we started growing post-COVID, we started doing a portfolio post-COVID. So you can say that safely you can tell about 36 months of vintage on a critical mass.
Okay. Any targets on the AUM that we are targeting for the housing finance company? Long-term, medium-term targets?
So, as I shared in my opening remarks, we see this company growing between 30 to 35% in visible future. So, within we would, if I give you another medium-term view, by 25 we should be touching 1,000 crores. We as a team are working to reach 1,000 crores by 2025. Maybe a quarter here or there, because we always prioritize quality, profitability and growth. But having said that, the way the things are stacked up currently, we see that happening by 25 March, maybe a quarter here or there.
Okay. Thank you very much. That was very helpful.
Thank you. Before we move to the next question, reminder to the participants, anyone who wishes to ask a question may press star and 1. Next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah, hi, good evening and congrats on good set of numbers. I hope I'm audible.
Yeah, good evening.
Yeah, sir, one question. If I look at over last 3 quarters, our cost of funds have actually been reducing while the mix has, in terms of the sourcing mix, the assignment and the term loan have risen. And if we look at it on the assignment side, the yields on assignment have gone down. So in a rising environment, are we getting term loans at a very attractive rate, which is helping us keep our borrowing cost low? Or
to just correct the data, I think our cost of borrowing is increasing because as you are aware that there is a repo rate rise of 2.25% last year, and the transmission started happening from Q4 last year, and we think that it has picked up right now because our majority of our borrowing is MCLR backed borrowing. So as per the MCLR reset in Q4, Q1 and Q2, our cost of borrowing increased correspondingly to the rise in MCLR. In terms of the various sources of fund, I think we borrow term loan anywhere between 9 to 9.75%, whereas assignment is without recourse to us, so it is between 9.5 to 10% because there we don't have to bear any credit cost. So effectively, if you see from a business point of view, assignment works out to be a cheaper avenue for us as compared to term loans. And we are trying to maintain that in a range of around 20 to 25%.
Yeah. Sorry, my mistake. So the point which I was trying to understand is that if we look at sequentially, the NIMs have actually risen for us while the product mix, the loan mix between MEL, SME has been largely similar. So what is helping us? Is it repricing of most of the loans which has helped us improve the spreads?
So last time also we shared with all of you that since our loans are short-term in nature, we get an opportunity to reprice it. And since we could reprice it, and the strategy of the company is to maintain NIMs at around 6.75 to 7%, that helps us maintain our NIM or grow it marginally depending upon the product configuration which changes from time to time. So this is the reason for maintaining the NIM is this.
And most of the loan book would be repriced by now. So this 6.97 can sustain for second half, or how should we think about it?
That is how we plan our capital and debt allocation. But we are a multi-product company and we plan our allocations among every product in such a manner that we maintain around 7%, 6.75 to 7% mean, and that translates into ROA post-tax anywhere between 2.75 to 3% is the conscious effort and endeavors of the company from time to time.
Okay, and last question on the branch addition. So what is the total branch addition we are looking at for this year? And as a result, would the cost to income remain around that 31.5, 32 range, or yeah?
I think we in Q3 and Q4 we should see another 15 branches being added. So from 175 we can be around 185, between 185 and 187 branches. And since we have a lean structure at the branches which does not entail much cost in terms of infrastructure, the only cost is of the manpower. And all the already branches which are open will also have critical mass. So we are confident that the operating expenditures will be a range bound between 30 to 33%.
Okay. Thanks, sir. I'll come back in the queue.
Right.
Thank you. Next question is from the line of Madhu Chandade from MC Pro. Please go ahead.
Hi. Good afternoon and congratulations on very steady performance. My question is on the housing finance subsidiary. So we have seen some early signs of growth picking up, but as ma'am alluded to, the kind of 60 lakhs kind of an impact due to network expansion. So I really wanted to understand what is the road ahead, what kind of branch expansion are you looking at, or what could be the steady state ROA of this business once it reaches that 1,000 crore mark. A little more color on the housing finance business.
I think on a steady state basis, to start with your last question, on a steady state basis at 1,000 crores and 4,000 crores, we see ROA settling between 2 to 2.5%. And we are predominantly a housing finance company with a limited portion of LAP, and that is a very conscious decision by us to concentrate more on housing and construction finance, and that too in semi-urban and rural. So given that business model, we anticipate ROS to settle anywhere between 2 to 2.5%, given the fact that we get the right type of operational efficiencies. And a slight contraction in profitability by 60 lakhs of rupees on Q1Q basis or 5 lakhs on H1 to H1 basis is because of the work in progress in terms of building up the portfolio. So I don't read much into that, but over a period of time, we will settle at around between 2 to 2.5% as I see as of now.
So this kind of network expansion that you have embarked on to really accelerate the business, for how many more quarters do you think this business will be in this build-up phase?
I think by up till we build up a critical mass of 1,000 crore. So it will be for at least next for around 6 quarters. It should be in a build-up phase. Thereby, we'll be making different ROAs and different profitability, but not at the optimum level of around 2 to 2.5%. Currently, it is at around between 1.5 to 1.6%. So it will be that range bound during this 6 to 8 quarters, but later on we can see that building up between 2 to 2.5%.
Great. I have my last question, which is like everything seems to be kind of touch wood working well for us in terms of growth, albeit the rise in the cost of borrowings, we have been able to maintain the NIM. So what are the things that makes you cautious at this stage, and what is your take on the competitive intensity now that you are reaching a critical size? What are the headwinds that you see in the coming 1 or 2 years? What makes you kind of cautious?
As far as lending is concerned, caution is the name of the game. So we have been cautious right from the word go in extending credit where it is due, prioritizing quality, profitability over growth. Having said that, we were fortunate to register a 36% growth even though with this approach. So given the market size, I personally believe, being a practitioner for 28 years, that it is very important for you to have the right intent in creating various products and addressing the credit demand of the market, and neither get too overexcited or worried about the competition. So this has worked with us during all these 28 years. We have seen a lot of competitors coming and changing their products or changing the businesses. So we are not worried about the competition given the market size and our niche expertise. The market size is huge. It is incumbent on us how we really address it, what are our strategic intent in terms of building up a quality portfolio, and whether we are courageous to be patient or not. In an atmosphere where you can find a 3-year-old company going from 100 crores to 5,000 crores, the question you have to ask to yourself is that, are you feeling the FOMO? And if the answer is no, you are safe. So we personally believe that this is not a business to get overexcited when you are working, where you have your 100 rupees invested and another 400 is coming from the other investors and the debt providers. It is incumbent on us to be very cautious. So this is what we work on the philosophy, have done good for ourselves from 2 crores to 10,000 crores, and are confident to take this forward in the same manner.
Thank you, and all the best for your onwards journey.
Thank you so much. Thank you.
Thank you. Next question is from the line of Shrestri Jagati from Ambit Capital. Please go ahead.
Hi. Good evening, sir. Congrats on the good set of numbers. A few of my questions have gotten answered. Just a couple more. Sir, in terms of the newer geographies that we are looking at the expansion and the newer branches that we've opened, one is are we rolling out the entire suite of products that we have from each of these branches? Secondly, what sort of customer engagement are we seeing in the salaried personal loans and CVs? And if you could talk a bit more about the competitive intensity and the customer profiling that we are looking at here.
On our expansion of branches, if you see, currently we work at around 8 states now. Four are the western states which are congruent, that is Gujarat, Rajasthan, Maharashtra, MP. 3 in south, that is Tamil Nadu, Karnataka, and AP/Telangana, and 1 in north, that is Delhi and periphery of Delhi. On the type of products we introduce, it depends upon the scope of we find for each product. Say, for example, currently if we talk about our southern penetration is more concentrated on commercial vehicle and SME. So is the case with our northern penetration. We have started with SME branches and soon we'll be introducing commercial vehicle and other products from time to time. So depending upon the scope we find from time to time and our strategic intent to grow a product, we'll start with those products and gradually introduce few more products as we get the confidence about the understanding of the demography and we have the right team at place. In terms of customer profiling, in terms of salaried personal loan, I think we saw the ones between 25,000 to 70,000 of income. As I shared earlier, we are very cautious to increase our share here in terms of our AUM. We are currently at 4% and we see ourselves in going to 10% within the next 4 to 6 quarters. And we'll wait and watch about the performance of the portfolio, how it generates risk-adjusted returns for us. So far it has been satisfactory and there's a lot of learning also. In terms of commercial vehicle, with the economy stabilizing and registering a continuous good growth post-COVID, commercial vehicle is a business which is directly linked to the economic growth, that is the GDP growth. That is where we are seeing a lot of traction and we have focused there also. And as you see, we have registered a good growth, maybe on a very small base of just 270 crores as on September 22 to taking to a good mark of 500 crores. I see, presuming that the economy is going to perform in a benign manner and at a continuous and a steady state manner, I think there will be a lot of scope to expand our commercial vehicle business. So we're focusing there also.
Right, makes sense. Sir, just to confirm, what would be your ideal product mix currently with micro enterprise loans and SME loans forming 82%? You mentioned salaried personal loans, which is currently 4%, would scale up to a 10%. So I am just wanting to understand what is the ideal product mix that we are looking at?
On a 3 to 5 year basis, I shared in the morning on one of the channels that we would like to have around 20 to 25% from housing, 20 to 25% coming from wheels, close to 10% coming from SPL, around 35% coming, 35 to 40% coming from SME, and the rest from MEL. So MEL MSME will form around 50 to 60%, and the rest will be coming from the other products. So this will make us a well-diversified asset company.
Understood. That's it from me. Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1 on your touchtone telephone. Next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good evening, everyone. So, first of all, congratulations for a very good set of numbers and a fantastic journey so far. So my question is that now, since we have reached 10,000 crore, or we are close to that 10,000 crore mark, we are at a scale which is, from where to grow at 20-25%, may require a slightly different approach. So, or is it going to be the same? If you can talk a bit about it, that how do you think about next 10-20,000 crore? Are you feeding new businesses to kind of go to that level, or the existing products can take you to that, new geographies? It can lay out a roadmap for that.
So at max, 10 years is a medium-term vision, and we envisage that within the next 10 years we should, on an average, grow at around 20% or between 20 to 25%. How we intend to go there is, first of all, the strategic intent. The strategic intent will remain the same. So we went for 2 crores and we are at 10,000 crores. I personally believe this journey was more difficult from 2 to 10,000 crores as compared to 10,000 crores next, whatever it happens in next 10 years, say 50,000, 60,000 crores. Because of the critical mass what we have and the learnings what we have over all these 28 years. So the strategic, it all starts with the strategic intent and the fundamentals which we need to follow, whereby we prioritize quality of assets, profitability and growth. We'll be courageous to be patient at times. We have demonstrated that during COVID, we grew our balance sheet by 11% because we were not very confident. Lending is all about confidence. So first is the strategic intent. We would like to carry the same strategic intent and priority as we have been doing since last 28 years. On the strong enablers, there is a very huge market size to be served. Each of our product has a potentiality to individually, if I keep a ballpark figure of around 50,000 crores 10 years down the line, each of the product has a potentiality to reach individually there. So with around 5-7 products around, including housing, market size should not be a problem. As I shared in an earlier query, that market size and competitive scenarios are all to be navigated according to a strategic intent. And that is what we have witnessed being a smaller company also. So this is one of the strongest enabler. There are multiple assets and the multiple products, the huge market size, the experience. And as I shared in my opening remarks, we have run the company on a self-propelling capital requirement model, whereby to grow at around, say, 20%, we do not have to raise capital now and then. Having said that, we'll definitely raise capital over a period of time. But it's not incumbent on us to raise capital for that growth. So that gives us the room to grow the way we have in alignment with our strategic intent. So the huge market size, experience, self-propelling capital model, and the strategic intent at place, I think we are more than confident, but not complacent nevertheless. And learning and unlearning has to be very sharp. And that is what we have demonstrated over all these years, and we think that will take us to there. And having said that, on execution, we look at one link of a chain at a time. And that is how we prepare ourselves for the next link and the next phase of growth.
Okay, very useful, sir. So second question is, what is the overall proportion of fintech plus co-lending in the book, and where do we see that over next 2-3 years?
Fintech with co-lending, I think must be very less than 5% of our total AUM. And we are still watching that space closely in terms of, I think regulations have settled now. Now, basis the new regulations, how the quality spans out over a period of time for the fintech players we are working with. So we would not like to rush in terms of our increase in proportion of asset created through fintech, which is currently 5%, will grow gradually as and when we get the opportunity and as and when we are confident about the asset quality over a period of time.
Okay, so this 5% may be close to 7-8%, but not a large proportion, right? That's the right way to work.
Difficult to give the number to that, but it will not be significant.
Okay. And sir, off lately, post-COVID, what we have seen is that we have grown quite handsomely on the two-wheeler and on the wheel side of the portfolio. The one reason, of course, you mentioned the economy is doing well, so we are kind of getting there. But prior to COVID, I think we had slowed down on the two-wheeler side and the wheel side. So what has changed? Are we kind of, bringing these products to more geographies? Are we reaching out to more dealers? Why this portfolio has started growing at a very decent pace, and how do we see that? Do we see that growing at 25% numbers at a company average number?
First of all, from time to time, we evaluate the risk-adjusted return that the product can offer. So pre-COVID, if you remember, the economy had slowed down, and all the commercial vehicle lenders also had some problems pre-COVID. So at that time, we were not much focused on increasing that book. But post-COVID and after 4 to 6 quarters of COVID and the continuous economic growth, and the assumption that this will continue for during the visible time, we have started focusing more on our wheels portfolio. And the reason for increasing the AUM is our more focus on wheels portfolio, and our more focus on wheels portfolio is because of our confidence on getting the desired risk-adjusted return while allocating capital and back to these products.
Okay. That's the last question. So we have entered this new segment of, personal loan, salary personal loan. But from whatever we have observed, this segment, a lot of players have entered and that market is getting crowded. Of course, the opportunity can be very large. But what is our thought process of entering this? What kind of, customers we are targeting? Why would we be, in spite of slightly higher cost of borrowing than banks, why would we be able to tap to this segment, without taking undue risk? If you can talk a bit about that.
So as I shared earlier with one of the queries that we saw the segment anywhere between 25 to 70,000. It's a very huge market to be served. And as far as India is concerned, we have to be ready to become a consumption economy. And we were always there on the livelihood side of the economy when we are missing the consumption side. So we would like to understand this space better because this is going to give a lot of opportunity. There will be a lot of hiccups for the players who want to grow very fast, or the ones who have looked the other way on the basis of the credit extension and growing the book very fast. But if you extend credit where it is due, and if you understand and manage the way and grow your book in accordance to your management capabilities and risk-taking capabilities, it's a very good product to have in your basket. So we are confident that this product will contribute close to 10%, will contribute profitably, but it will take its own time. And the reason for entering is that this is a very huge market size to be ignored. And India, as we know, that the story of India depends upon its domestic consumption, and domestic consumption automatically will lead to more indebtedness, and we'll have to understand and live with that. So we think there's a lot of opportunity, but good players and the players who do it with caution will definitely have a good experience from this product.
So what would be the typical yield from this product, 12-13%? What will be the yield, typical average yield on this product?
The average yield ranges from 14 to 16%.
Okay. Got it. Thank you. That's so much.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on your touchtone telephone. We have our next follow-up question from the line of Omkar Kametkar from Bonanza Portfolio. Please proceed.
Thank you for the follow-up question. Firstly, I would want to know what is the average yield of the standalone entity and the HFC, if that could be shared. The average yield for the entire portfolio.
The average yield for the entire portfolio is close to 16%, and for housing finance it is 14 and a half.
14 to 14.5. Okay. And what is the marginal cost of borrowing for both the entities separate? If it is possible to share both separately, is it possible?
It is both in the range of around 9.5 to 9.75%.
9.5 to 9.75. And with respect to disbursement, what was the disbursement for the quarter for MAS and the HFC? The disbursement numbers, and what are we targeting for end of FY24 and 25? Are we placing any targets in that aspect?
I usually don't have targets for disbursement. It is targets for AUM, because there are various metrics to disbursement to AUM depending upon the product. So difficult to use a target for disbursement. We target an AUM of concentrated AUM of exceeding 10,000 crores by December. And in terms of disbursement, I think we were close to 2450 crores, approximately 2450 crores in our parent. and close to around 70 crores of disbursement in housing prices.
Okay. And the mix of the housing finance portfolio, what is it more skewed to? Is it more towards the salaried individuals or self-employed ones?
It is split 50-50.
Split 50-50. Okay. And I would want to understand with respect to how do we geographically expand. So now we are concentrated more towards the western and central part of the country. Most of the branches are in Gujarat, Maharashtra, and Madhya Pradesh. So how do we expand? So what is the route that we take expansion through? And could you please explain that so we can have a...
So the expansion is the function of a well-defined process. It starts from the potentiality that a center can offer. Then the credit behavior is examined, and then there is a lot of recce done through various departments, that is sales, credit, collections, site visit guys, and then we come to a conclusion on the risk assessment of our demographics, and then we start with a product which is allied to a strategic intent for a particular center, and this is how we start working in a center, and gradually we introduce more and more products, and then once we enter a new state, we take some time to build up the team and understand the demography. So we are slow in disbursements during the first few quarters of our entering a new state, and then as we get the experience, we expand.
Okay. So how do we? So how is the decision with respect to entering a new state arrived at? Do we have a framework as to how do we expand? So So my question is comes from the point of where are we going to expand further? Are we going north? Are we going south? Where?
I think, as I said, we are there in the western side, Gujarat, Rajasthan, Maharashtra, MP. We are already there on the north with Delhi. So the next expansion can be Haryana from Delhi. And then in south, we are already there in Tamil Nadu, Karnataka. We have expanded to AP, Telangana. So within visible future, I think we would like to make deeper penetration in all these states of operation, because we have covered good number of states in terms of our initial entry through various products.
Okay. And finally, with respect to new products in pipeline, do we have anything new in the pipeline with respect to any specific product that we might introduce?
I think we currently we do used cars, but it is clubbed with our commercial vehicle business because the business is not substantial, and we are trying to gain a foothold in the used car market since last 2-3 quarters, and now we have built a reasonable team. So within the next 2-3 quarters, we'll see used car being hived off as a separate product in wheels, where once it reaches a critical mass in terms of AUM of 150 crores plus. So that you can reckon it as a new addition, while we are already working on the same.
Okay, so currently the used car is clubbed in the CV, but it would then become a separate entity on its own.
Yeah.
Okay.
Yes.
Okay, thank you. That was very helpful.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Mr. Shripal Doshi for closing comments. Mr. Shripal, your line is unmuted.
Am I audible now?
Yes, sir, you are audible.
Yeah. Thank you, Yusuf. I would like to thank all the participants for being part of the call. A special thanks to the management of Mass Financial for giving us the opportunity to host this call. Thank you all.
Yes. Thank you. Thank you, everyone.
Thank you. On behalf of Equirus Securities Private Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.